Okay, good morning everyone. Your accounting tutor here. So today we're going to learn how to post adjusting journal entries, especially related to bad debt provision or bad debt expenses or and trade receivables. Okay. So as usual, this is an example I made up. Okay. So you can see the target fiscal year is January 1st, 2021 to December 31st, 2021, and then information from company A's latest account. Okay, so they told us the trade receivable is 100,000 as at year end, right? Okay, so they give us the end balance, but can we trust this number? Okay, maybe not. So they give us a bit more notes. Okay, so bad debt of 5,000 needs to be written off. Okay, and then a provision of 3% is to be made on the remaining balance of trade receivables. Okay, so I need to do adjustment, right, related to these two pieces of additional information. So first, bad debt of 5,000 needs to be written off. So this is a direct write-off. Okay, so solution. So first is related to a direct write-off. Okay, so we know because it's a direct write-off, which means we reduce trade receivables balance directly. Okay, so debit side, bad debt expenses goes up by 5,000. Okay, and then the credit side, trade receivable goes down by the same amount. Okay, so we are writing off trade receivables value by 5,000. Okay, so this is the journal entry for direct write-off. Okay, so by the way, bad debt expenses 5,000. This part needs to go on our income statement. Okay, and because trade receivable is an account sitting on our balance sheet, so we know, okay, we need to go on balance sheet to adjust trade receivables and balance. Right. Okay. Second step. So after doing this direct write-off, they say a provision of 3% is to be made on the remaining balance of trade receivables. Okay, so first thing first, we need to calculate the remaining balance of trade receivables, right? Because we did the adjustment. We reduced 5,000 from trade receivables account, right? So now the end balance or remaining balance of our trade receivable is originally is 100,000 minus 5,000. So now the end balance of remaining balance of our trade receivable account is 95,000, right? And then it told us a provision of 3% is to be made on the remaining balance of trade receivables, which means 3% of this 95,000, you need to park this amount away as your provision. Okay, so the journal entry will be bad debt expenses goes up. Okay, and then the credit side is bad debt provision. Okay, and the value will be 3%. Let's do 3% times the end balance of trade receivable. Okay, and then the same number goes here. Okay, so you can see this is the journal entry, okay, for booking the provision, and this is the journal entry for the direct write-off. Okay, and by the way, because it's bad debt expenses, so we know it needs to go on the income statement. Okay, and bad debt provision is the opposite account of trade receivable, so bad debt provision, this account needs to go on our balance sheet. Okay, so the total bad debt expenses for the year will be 5,000, right, plus 2,850. So on our final income statement, okay, this number should be sitting in bad debt expenses, this account. Okay, right. Your accounting tutor here. Let me know your thoughts.